Hey America, you think you're smart parking your 401k in a cheap S&P 500 index fund and forgetting about it. What if I told you that set it and forget it is quietly making you a guaranteed buyer for whatever company sneaks its way onto the list? And somebody just did exactly that. Hey folks, welcome back. If you're new here, hit that subscribe button and turn on notifications because we're diving deep into the stuff they don't teach you in the mainstream finance glow-ups. I'm talking real money, real risks, and what's actually happening with your retirement savings right now. My name's Orbit, and I've been following markets for years, not as some Wall Street suit, but as a regular guy who watched family and friends get hammered in '08, then chased the next hot thing, only to get burned again. Today we're talking about something that sounds boring but is quietly reshaping trillions of American dollars: passive investing. You've heard the pitch. It's been sold as the ultimate triumph of common sense over Wall Street's hotshot stock pickers. Low fees. Instant diversification. Set it and forget it. Just buy the index, ride America's growth, and retire comfortably. Vanguard, BlackRock, State Street, they make it sound like the most responsible, patriotic, no-drama way for working families to build wealth. And you know what? A lot of that is true. For decades, passive investing has crushed most active managers after fees. It's democratized access to the market for teachers, nurses, truck drivers, small business owners, people like us in the heartland who don't have time to day trade meme stocks. But there's a part of the pitch nobody ever mentions at the dinner table or in the slick TV commercials. The same mechanism that makes passive investing so convenient, that automatic buying, also turns every index investor into a guaranteed buyer for anyone who can squeeze their way into the index. No vote from you. No email asking if you want in. Just boom. Your money flows in. And right now, somebody just squeezed their way in. Let me back up and tell you the full story, because this isn't just theory. It's affecting your 401k, your IRA, your kids' future, whether you realize it or not. The American dream meets the index fund revolution. Go back to the 1970s. John Bogle at Vanguard launches the first index fund for regular people. The idea was revolutionary. Instead of paying high fees for some guy in a suit to try beating the market, and usually failing, just own the whole market cheaply. It took time, but it caught fire, especially after the 2008 financial crisis. People were sick of hedge funds blowing up and active managers charging 1 to 2% while delivering average results. Fast forward to today, passive strategies control trillions. In the US, a huge chunk of the stock market is now owned by funds that basically just mirror indexes like the S&P 500. For the average American, this felt like liberation. No more getting ripped off by high fees. Your money grows with corporate America. You don't have to watch CNBC all day stressing about earnings reports. I get the appeal. My dad worked in a factory in the Midwest. He didn't have time to analyze balance sheets. He wanted simple. Just put it in the S&P and let the country do its thing, he'd say. Millions of us did exactly that. But here's where the story gets interesting, and a little uncomfortable. How the magic trick really works. When you buy an S&P 500 index fund or ETF, the fund doesn't pick stocks based on deep research. It follows rules. The S&P Dow Jones Indices Committee decides which 500 large companies represent the market. Criteria include market cap, profitability, liquidity, etc. Once a company gets added, index funds must buy it, often in huge volumes, to keep tracking the index accurately. This creates automatic demand. No negotiation. No. Is this stock actually worth it at this price? It's mechanical. Think about that for a second. You, the passive investor who loves the low maintenance part, become the ultimate forced buyer. Companies and their early investors, executives with stock options, venture capitalists, know this. Getting into the index isn't just prestige. It can trigger a wave of buying that pumps the stock price. Recent examples? In 2025 and early 2026, companies like Robinhood Markets, Hood, AppLovin, App, Emcor Group, and later Vertiv Holdings, VRT, and others made the jump. These additions often come after strong runs, meaning index funds are buying at already elevated prices. This is the index inclusion effect. Studies have shown stocks can jump on announcement and rebalancing day because of this forced buying. The human side, your neighbor's retirement. Let me make this real for you. Imagine Sarah, a 42-year-old teacher in Ohio. She's got 2 kids, a mortgage, and a 403b that's been auto-invested in a target date fund tracking the S&P 500. She feels responsible. I'm diversified, she tells her friends. She doesn't know that when a flashy new tech or AI-related company gets added, maybe one with heavy hype but shaky fundamentals, a chunk of her contributions automatically buys shares. Not because she researched it. Not because it passed some rigorous value test. But because the rules said so. Or take Mike, a construction worker in Texas with a 401k through his union plan. Same story. He survived the dot-com bust and 2008. Passive felt safe. But that safety has a hidden cost when the index becomes a conveyor belt for whatever's hot right now. This isn't conspiracy talk. It's mechanics. And as passive assets have exploded, especially in 401k, and IRAs that millions of Americans rely on, the impact grows. The pitch versus reality. The original pitch was beautiful in its simplicity: own America. Bet on human ingenuity, innovation, and growth. Low costs mean more compounding for you. And for broad market exposure over long periods, that still holds up pretty well. America has been an incredible wealth creation machine. But the nobody mentioned part is this: passive investing outsources stock selection decisions to index providers. Those providers have criteria, but they're not perfect. They're backward-looking in some ways. Bigger companies get more weight. Winners get heavier. Momentum builds. This can lead to concentration. Right now, a handful of mega-cap tech stocks dominate the S&P 500. Your diversified fund might have massive exposure to a few names. When inclusion happens, it can create temporary price distortions. Funds buy high, after a stock's already run up to meet criteria, and sometimes those stocks underperform afterward as the hype fades. It's the opposite of the classic Warren Buffett advice: be greedy when others are fearful. Index rules can force the opposite at times, buying when enthusiasm is already high. Why this matters more now, 2026 edition. We're in a different world than 2010. Passive dominates more than ever. AI boom, meme stocks, SPACs, private equity exits. There's pressure for companies to hit the index for liquidity and prestige. Recent additions like data center and AI infrastructure plays make sense on the surface. America needs that tech, but the automatic buying creates its own momentum. Early investors and insiders can benefit from the pop. You, the long-term holder, might be left holding the bag if valuations were stretched. Plus, with so much money flowing passively, price discovery, the process where smart active investors dig into fundamentals, can get weaker in some segments. Markets might get more volatile when sentiment shifts because fewer people are actively countering the herd. I'm not saying the whole system is broken. Active management has its own problems: high fees, closet indexing, emotional mistakes. But pretending passive is flawless ignores real frictions. Stories from real investors. I hear from people all the time. One guy in Pennsylvania wrote, "I thought I was being smart. Then I looked under the hood and realized half my fund was buying companies I wouldn't touch with a 10-foot pole if I was picking myself." A retiree in Florida. "The index saved me in the long run, but the ride was bumpier than they promised because of these big swings when things get added or removed." These aren't dumb people. They're hardworking Americans who followed the responsible advice. So what should you do? I'm not telling you to abandon passive entirely. For most people, a core low-cost S&P 500 or total market holding still makes sense as a foundation. The simplicity and low cost are powerful. But get informed. 1. Look under the hood. Know what your funds actually own. Check concentration. Understand rebalancing dates. 2. Consider a blend. Some active or rules-based smart beta strategies that screen for quality, value, or low volatility can complement pure passive. 3. Diversify beyond stocks. Real assets, bonds, international, carefully skills side businesses. Don't put everything in one index basket. 4. Think long-term but actively aware. Passive doesn't mean brain dead. Rebalance your overall portfolio. Adjust as life changes. 5. Fees still matter. Even small differences compound massively over 30 years. The goal isn't to outsmart Wall Street every day. It's to protect your family's future from hidden risks in the popular solutions. The bigger picture for America. This shift to passive isn't just personal finance. When trillions flow mechanically, it affects capital allocation across the economy. Which companies get funding easier? Which innovations thrive? Are we rewarding real productivity or just index eligibility? As regular Americans, we should want markets that reflect true value, not just rules-based buying power. A healthy mix of active scrutiny and passive efficiency serves everyone better. Wrapping it up with hope. Look, I love that everyday people can invest cheaply. That's a win for the American dream. But love it enough to understand the trade-offs. The next time you see headlines about a company joining the S&P 500, remember, that's not just news. It's a trigger for billions in automatic purchases, including some of yours. Stay curious. Ask questions. Don't outsource your financial future completely, even to safe indexes. If this resonated, hit subscribe, like, and share with a friend who's got money in the market. Drop a comment. What's your biggest concern with passive investing right now? In the next video, we'll dig into specific sectors and what the AI/index boom might mean for your portfolio in the coming years. Until then, invest wisely, live fully, and remember, the smartest investors aren't the ones who never think about their money. They're the ones who understand how the game really works. Thanks for watching. God bless, and I'll see you in the next one.